when we go through what's happening in the product space, we always want to look at the average. What are things happening on an average basis, especially the four key drivers of gasoline, jet, distillate, and residual. So the current level was just below 15 million at 14.994. When last week, if you remember, was 14.91. So the average, brings us a bit closer to that 14.7 level. But again, there was that little bit of a spike. You can see that where we are today, you're starting to see that come down just a bit, just kind of in line with where we are on an average level, as we see some of these movements coming back up. When you look at that, where things fall and where things are sitting at this point, we expect it to again move down a bit just based on where some of the pressure comes in on the gasoline side. We had that big spike. Diesel, next week we do expect to see, or I should say this week, diesel will increase, especially on the heating oil front, because when you look at some of the demand, some of those key demand drivers, things get a little bit chillier on the East Coast. That's always going to be a big driver for heating oil consumption. And that's something that we're going to continue to see come through. And that's, again, just moving things over. But it's just going to keep us just below. When you look at where the average is, you can see that we're on an average level. We're still below where we were in 2019, in 2020, and in 2017. So just above where we were in 2017, which was that low point. So we do expect to see things kind of flatline here. We thought we were going to come a little bit lower on the average side. Instead, it's hung in, and there's a lot of the fun part about this period of year for anyone that trades natural gas. It's weather. It's a matter of what is weather doing, what are the storms doing, what are some of the impacts, and so the impacts were obviously on gasoline, which is why we focus just as much, if not more, on that 2022 average, because you take out some of that noise and get an idea of where is that real driver right now, where are we versus historics, and you can see that we're still a bit lower with some of that pressure remaining on across the gasoline and jet fuel front. Now, when we look at what happened in distillate, we had a draw of 930,000 barrels. That's still 29.7 million below the 5-year average, with pad 1 being the driver. We're seeing the only draw of 2.81 million, bringing us 19.2 million below the 5-year average, which is why when you look at Urals, when you look at diesel, especially that diesel coming from Russia, this is where you see some of those impacts, as the draw in pad 1 also included an increase in imports of 200,000 barrels a day, which is, again, as we were saying, based on what we were looking at on the tracking side, we were saying that we expected to see a bit of an increase in some of the imports. Again, this is a little bit higher than we were expecting. We thought it was going to still be above the 5-year average. We had a little bit of a spike. It's always a matter of timing delays. How quickly can they unload it? What is it? So because when you look at where the data is struck, sometimes it may bleed into a Sunday, Monday, Tuesday, or if they can get it done. So obviously here you saw more of it pulled forward, which was a fairly good number, and we will see this come down a bit, but again, still remain elevated. This is what we were talking about in segment 1, where just the rate of change is softening a bit. That's something that we think is going to continue, just especially based on some of the warmth that we're getting in some of the other areas. But we are getting a bit cooler on the East Coast, which again will pull some of the additional capacity. Now, when you look at production side, because remember there was a fairly sizable spike in production on the crude runs from a gasoline and distillate side. Distillate was fairly flat. Gasoline was a small dip, but nothing too meaningful in terms of where some of that adjustments were coming from. As we were saying last week, we thought there was going to be that dip closer to, again, back within the top of the cloud. We weren't expecting to come back to the 5-year average. Distillate, we think, just stays above that 5-year average, and it's gonna waffle back and forth between setting a new seasonally adjusted high or just falling right back in essentially the middle of that cloud. But all things point to just, again, distillate products still being on the robust side of the demand spectrum, and just where on the pricing side as well as the storage side, that's where we're going to continue to see. I think this is a good chart that reflects what we were discussing on some of the hiccups with the weather. because for some, there were, I should say, large swaths of land and road were iced over. So you did see some of those adjustments, and it showed up in the trucking demand side. You can see that there's still load availability. It dipped a bit, which then came down in the market demand index. We do expect that to come back up a bit and just stay within the upper bound. But this is, again, showing some of those pressure points that we were talking about. This would impact the diesel market. Then gasoline cars obviously would affect the gasoline side. And that's where we think that, as we'll get a little bit of a bounce in the distillate demand, and then we'll get a drop in that gasoline demand. So when we look at rail traffic, intermodal still fairly flat versus last week. Total carloads dipped a bit. And when you look at it, motor vehicle parts continue to be the overhang. Forest products, grains, those are things that have hard comps. And one of the things that is going to remain strong will be coal. So again, there's just more movement, more things coming through, and just a lot of activity at this point in time. And here's why. We still have a significant amount of cargoes waiting to unload. More ships, more boats keep showing up. And again, that's going to continue to pull things and keep the supply chain, very, very busy, if you will. And again, supporting that diesel, supporting some of that distillate consumption. Now, rounding out that side, you can see that essentially from the Mississippi east, you're going to have temperatures that are either slightly below or a bit likely below their normal. And again, that's going to be some of that bullish backdrop for additional heating oil, which is something that. But then when you look at other parts of the country, you can see that there's things that are going to be slightly above normal. So this will be bullish for Pad 1. This will be bullish for that storage side as things continue to see some broader builds on the heating oil distillate front. So gasoline had a drop of 1.65 million. That brings us 6.2 million below the 5-year average. You can see that we had a slight increase in imports of 81,000 barrels a day. That was driven by Pad 5, and this comes down to timing into Pad 1. There was a much bigger focus on getting some of that distillate in. So this is something that we would expect to see this bounce a bit. It'll remain just a bit below the 5-year average, but just given where European gasoline storage is, we would expect to see some of that come through. Now, we do expect to see a bit more builds, just given, again, some of that timing delay that had happened. That has now, our famous last words, because maybe there's another storm that is going to be bigger than they're assuming. But this is something that we would expect this to continue up and move closer to that top end of the cloud, or I should say the very top end of the cloud. Blending components had a drop of 1.4 million. That's still 1 million above the 5-year average, and we think that's going to continue again to trend higher, as we've talked about. Now, when you look at Google Mobility Index, things have flatlined a bit in the U.S. There's not too much to say one way or the other on the Americas. In terms of good or bad, it's just kind of the same at this point. When you look at Asia Pacific, it's starting to roll over a bit. That is something that we think drops a little bit more. Again, nothing crazy, just given Indonesia bringing down some of their movements, tightening some of the restrictions. You can see that in China, there was that big dip. That was obviously Lunar New Year. And there was actually a fairly sizable drop versus last year and versus 2019 in not only spending, but also travel during the Lunar New Year, as they were still concerned about Omicron. Some people were still under lockdowns, and people really didn't do all that much. And then the Apple Mobility, again, kind of stays, pretty tight within the level. The one thing that we're seeing is Europe starting to get back to a bit more activity. And that's something that we think increases a bit. But because there's so much gasoline in that market, we don't see that really, even as activity increases, we don't see that absorbing all that much additional storage, just because refiners are trying to throw off as much gas oil as possible, which is, again, going to increase the diesel side, the gasoline side. So when you look at some of the timing delays, if you remember last week, you see that there was that big spike in, or not big, but a sizable move higher in gas buddy data, and that was where we were saying, like, look, we had that small drop in gasoline demand. We really should have seen an increase. We saw it in Gas Buddy data. Now, this, if you're looking at it, you're kind of seeing that the U.S. weekly Gas Buddy data is about a week ahead of where the EIA comes through. So now things are coming back down, normalizing a bit. So according to Gas Buddy data, the weekly U.S. gasoline demand fell 3.7% from the prior week and was 2% below the rolling 4-week. Then when you look at this Tuesday, I should say yesterday, the Tuesday, there was a big decrease versus last week. And why? Because everybody rushed to fill up. So it was a drop of 15%. But that's when you turn to the 4-week average, and it was only about 1.3% below the 4-week average. And that's why it's important to look at where are we against the 4-week. And one of the things that we've been saying is we should be anywhere between 1.7% below, 1.2% above, and we're just going to kind of stay within this fairly tight range as we go through really the end of February. But then we'll start to see an increase as we come out of, or I should say, as we go into the end of February, again, as people start driving for spring break and winter break. Now, this is going to get in the way. There was a big increase in gasoline prices by 7.6 cents. So now we have February 7th, as of February 7th, the total U.S. gasoline price was 3.444. So again, big increases in gasoline prices, big increases on the across the board. The bigger concern, especially when you're looking at inflation, when you're looking at road fuel, when you're looking at heating oil, was road fuel is now approaching $4. We're at $3.95, and there was an increase of a little over 10 cents last week. So again, that's going to be the bigger issue when you look at the cost of goods, the cost of moving goods. I mean, for those, we get Poland Spring delivered, and we just keep, I would say, every 2 months, they're just increasing prices on, diesel surcharge, on the rental fee of the dispenser, and by bottle. I mean, it's either anywhere from 50 cents upwards to $1.50 in terms of increase in price. I think this most recent one was $1.99. So again, this is why. When you look at diesel, this is a huge component because this is a straight pass through. So again, that's going to be one of those bigger drivers on the supply chain costs and underlying inflationary pressures. So when we look at the blending components here, you can see we're just kind of sitting in normal territory. We just expect it to waffle up and down and just really follow this fairly closely. And then as we get towards the end of March or towards March, that's when you start to see some of the shifts because your refiners are going to start preparing for summer blends, which officially have to be sold as of the Memorial Day in May. But you have to start moving it through the system. You have to start preparing. So that's where you start to see some of those drops that we've that you can see in that level. When you look at the increases here, you can see that there was that big spike in gasoline demand. We're just right back to the highs. That's one of the things that we expect is to come back down and just fall back below the average. Again, not by a huge amount, but just stay below just where some of those levels are as some of that weather, those weather issues clear out. Here you can see a little bit tighter. There was a little bit of a dip in terms of activity. Again, just kind of sideways. We're not seeing any real push one way or the other. There is a little bit more activity on the open table side. So we'll talk about that as well. Mask mandates are being lifted again. So maybe people feel a bit more comfortable going out. So that's something that we're going to have to look at to see, are people still staying home or getting a bit more active. Apple data, fairly stable, kind of a sideways move from last week, and we don't see too much changing. On the propylene side, there was a draw of 1.92 million, bringing us 9 million below the 5-year average. You can see that the pace slowed. So now we're inside where we were versus 2017, and that's something that we think that we're just going to hug that 2017 level and continue to move lower. When you look at the day of supply for propane, you can see that it's accelerating to the downside, and it's not driven by the store. I mean, storage came up a bit. It's still a draw, but not as sharp as other years. But demand is much higher. So again, days of supply, is a calculated number, and that's where you can see the acceleration down in terms of days of supply in the propane space. Now, when you look at jet fuel, as we said before, jet fuel had an increase of 1.07 million in builds, and just it stays within this fairly tight range, and we don't see it deviating at this point. Still below that normal, but just kind of waffling back and forth within that fairly limited component. But then as we get into the end of February, we're going to see a bit more of this demand coming through, and this is why. So the passenger still continues to underwhelm. We're below where we were in 2020 and 2019 on an average basis, but typically speaking, on a timing level, we'll start to see a bit more passengers coming through. And again, this is as we're out of January, we get a little bit more activity on business travel. We're going to have people traveling for winter and spring break. So again, that's where you'll see that continue to grind higher, which we had in 2021, we had in 2019. Obviously, 2020 was a special year, but we normally start to see those increases over the coming weeks. So don't be surprised when we see that. And then, but the day ahead departure scale, so the passenger flight schedule for the 12 weeks ahead is 1.5% lower week on week. Again, just kind of staying fairly flattish, a little bit of a decline, but you're just seeing some of those headwinds. Now, more recent data, we actually saw an increase. So when we look next week, we should actually see an increase week over week, 12 weeks out, and this will be the first one. I think it's now in 10 weeks. It's the first increase, but I'll have that data as we go into as I build next week's show. So on the positive side, one of the things that we were assuming on the weekends that we were going to still see demand being 5 to 10% below normal on the weekends. Instead, here you can see that we were either minus 3% down or actually positive 2% up. That's something that we should see getting a little bit better, especially when you look at because the days are compared to the baseline of 2020 and 2019. So you will get a little bit easier comps when you look at where things sit. So that's where one of the things that is getting a bit better, but we do expect to see things be fairly flat on the weekends and about 15 to 20% down on the weekdays. So that's what we have for you on the U.S. refined product side. And now in the next segment, we're going to go obviously a bit broader, look at what is happening in the international market and where some of those differentials and shifts are really occurring.